Morning, everybody. We'll get going because there's quite a bit to get through. People are still joining as we go along. But Richard and I are going to do some news. Then Andrew McHattie is going to talk about what happened in January. And then our guest this week is Sebastian Lyon, who's the manager of personal assets. News first. I just wanted to talk a little bit about these energy efficiency funds. And I feel like I've been banging on about them recently, but there's stuff going on. And then Richard's going to talk about a new potential new issue called GCP Co-Living. Energy efficiency first. Just to put the point up here, they aren't that old, and so we haven't actually got much in the way of returns, but they also haven't delivered much either, as we'll see. The whole sector's had a slightly better time recently, and that's because power prices are going up, and that's going to keep feeding through that and inflation, because inflation feeds into the subsidies, and that's linked to RPI and not to CPI. So all of these funds are going to be doing quite well, but the energy efficiency funds, if they're exposed to generation, they will be affected by this, but if they're not exposed to generation, then they won't be. So it's a bit confusing. Here's the lineup of the sector now. It's getting quite big now, as we know. The Aquila fund is now on a 14% discount after a dive the other day. We've got a few funds now on discounts. I think most of these, from what I was saying just now, are probably undeserved. So things like Foresight and Next Energy, even the Ecofin US one, they really shouldn't. There's no good reason why they should be on discounts, I think. And these two, though, we'll talk about a bit more. So there's the chart for Aquila, and you can see it falling off a cliff there. It's really in response to what's happened this week. But it wasn't doing marvellously well to begin with. It's about 8 months old. Tried to raise 150 million, ended up with 100 million. It's got that sort of innovative structure where it's got both sterling and euro lines of stock, which we like. And it was targeting sort of reasonable kind of income, so 3.5p for this year and 5p for next. But as we know from Triple Point, if you're paying that out of capital because you haven't deployed the money, then that becomes a problem. It's a European fund, so it's a European version of these energy efficiency funds, run by a German investment manager who's pretty well resourced. So there's no excuse from that point of view why they haven't been deploying the money. And they also had quite a hefty pipeline of assets lined up in the prospectus. So 210 million euros is well in excess of the amount of money that they raised. And these were supposed to be sort of near-term things in negotiations, 2 of which they held already and therefore could be just transferred across. And then a whole bunch of other stuff that was being put together that would become available a year after it was launched, so sort of summer this year. However, the prospectus, and it's all, I'm not going to read it out to you, but it was quite heavily caveated in terms of we might be able to do this, and they haven't, and it's not really clear why. These are the sorts of things they said they'd invest in, and I think this comes back to what we were talking about with STCL last week about what actually constitutes energy efficiency. So a broad spread of things, but all designed to address mainly sort of things like local generation, just replacing street lights, all this sort of stuff. It's quite a sort of deep pool of things that you can invest in, but a lot of them are quite sort of bitty. There's a 4-strong board at launch, all of them quite reasonably well suited to the job. Including this Lisa Arnold, who's an ex-analyst and the chair of Perth Capital Healthcare, and Laura Sanders, who's an ex-MP, was involved in the government's efforts to address climate change. And then this week, after not really saying anything at all since it launched, it came out and said that the NAV's now 96.92p, so that's just basically being frittered away as the management fees have been coming out and the normal running costs have been coming out. But it hasn't actually been generating an awful lot of income. And it has now managed to deploy, well, it's committed to deploy about 20 million euros. but that's still a long way behind where it probably should be, considering that it's supposed to be deploying the whole lot within 12 months, and we're 8 months in. So the striking thing, though, is that these two directors resigned basically on this whole issue of saying that it's not going fast enough. And the remaining two directors have instituted a review of the investment strategy to try and speed things up. And they'll also be talking to shareholders. I can't really fathom why the thing is so far behind. And I'm sure that there'll be people that maybe even on this call who might have a view as to why that might be. But because the share price has dived, it's now on a 40% discount. That's starting to look cheap to me, especially if it says this isn't really working. Would we give up? Let's merge it with a fund that's doing all right, ASTCL, or just hand the money back. If they don't do that, I think it might be quite a long road back, because once you've lost trust this way, I think it takes a long time, and obviously it's going to take a long time to deploy money and then start earning money, and then to build up a situation where you've got a fully covered dividend. So I think it's going to take a lot of time. The triple point one, that's gone to a small discount just recently. We talked about that one being slow to invest on the news show 2 months ago, and the fact that it was distributing capital because it hadn't actually committed the funds. And it did have some exposure to combined heat and power plants that were adjacent to greenhouses that were all let to APS salads when they growing tomatoes. And I said at the time there was kind of question mark over the profitability of that company, and that was slightly worrying because it's 30% of the portfolio. What they have done since is that they've bought quite a lot of hydroelectric, and that's now the biggest chunk of the portfolio. So they now have 9 assets, all in Scotland, 47 million quid's worth. And as we'll see in a second, they're doing very well. And then it's just agreed to contract to buy some grid-scale battery storage assets, and says it's got a much bigger pipeline behind that. So the hydro assets are trading very well. And they're going to be a big beneficiary of this RPI uplift to the subsidies. They've got a new power customer for the Teesside CHP plant, which helps diversify it a bit. They're going to run into a 40 million credit facility, so that will help returns accelerate too. So it looks like it's turning itself around. The only criticism I've got is whether those grid-scale battery storage really count as energy efficiency or not. And notice this debate we've got, and also the same thing for the hydroelectric. But if you have got a fund that will be earning money and should be sort of putting itself together, and I think then it'll want to come back and look for more cash, but we'll have to wait and see whether it can convince the market to do that. So I'm going to hand over to Richard now.
Great, thanks, James. Yeah, so announced yesterday that we could have our first investment trust launch this year, GCP Co-Living REIT. Intention to float announcement yesterday. So these are the salient details. They're looking to raise 300 million to invest in 3 co-living assets for 425 million. I'll come on to what sort of co-living is in a bit. But 2 of they're all in London, 2 are operational, and 1 is still at development phase. They're targeting 4% yield, and then which will increase to 5% when the development completes and comes online. And they're targeting 8% NAV total return per annum. Now, these assets that they're looking to acquire have had a bit of a checkered history. So they form part of a group called the Collective, which specialised in sort of co-living and stuff, sort of quite a pioneering company actually, doing what they're doing. But they fell into trouble during the pandemic. I think occupation rates fell to about 80% during the pandemic. So fell into trouble and then went into administration last year. they had about 6 assets or a few more, but and GCP Asset-Backed Income, another of GCP's funds, provided a loan to this company. So as a sort of solution, they formed a syndicate with other lenders to buy 6 of the assets to recoup some of the value by selling them off. They've managed to sell 3, leaving these 3 remaining, and obviously they're looking to roll them into a new fund. So the assets, 2 the operational ones, there's 1 in Canary Wharf, 1 in Old Oak Common, which is West London. They say 95% occupancy now, so that's come up, which is good, and they account for around 90% of the co-living schemes in the whole of London, which seems amazing. 1 development site, as I said, and they've got a further pipeline of development sites worth about £1 billion. So co-living they're apartment blocks which have a lot of communal areas, things like gyms, games rooms, cinema rooms, libraries, things like that, and they're targeted at young professionals, so people coming out of uni who've sort of got used to living in these purpose-built accommodation with all these sort of nice facilities and things like that, and they're obviously professionally managed, and they're cheaper than renting, so it's a good solution for the professional young professionals who can't afford to rent in London and things like that. And the 95% occupancy suggests that there's pretty good demand for these, and due to the changes in tax on buy-to-lets and houses in multiple occupancy and things like that, then the supply of them have been dwindling. I think it's dropped 11% in London in the last 3 years. So so this seems a good sort of supply and demand dynamic here. It's a nascent sector, as you can see, with the 90%, these 2 forming 90%, so it's quite a young sector. But the group says pre-pandemic annual rental growth of about 3 to 4%. So it's an interesting one. The manager, of course, the GCP, and the investment team will be led by Nick Barker, who was the lead at GCP Student Living, which sold last year for just under £1 billion. This, as you would expect, management fees, and the timetable there. So the get out prospectus early next week, I would have thought, or soon anyway. Offer opens this month, ends in March, and they're looking to complete the acquisitions by the end of March, which is obviously very quick, assuming they get the funds that they need. So it's a really interesting one. We're going to write a piece on it later today, which goes into a bit more detail, and yeah, it's really interesting sector to be launching on.
Cool. Thanks, Richard. Now we're going to hand over to Andrew. Take control.
Lovely. Thank you very much indeed. I'll just switch over to my screen and talk about the movers for January, which, as we'll all know, was a pretty poor month overall for markets. But of course, in such a diversified sector, there were some gains. These are fairly muted figures this month, and there are a few notable things there. Temple Bar, the real flag bearer for the value sector, is on the list of risers. And it's very nice and quite a refreshing change to see Tetragon Financial on the list there, which has been a serial underperformer for a while. But that was quite interesting. It had a big bump in its December NAV after revaluing its largest holding. So the NAV was up 11%. And for a few days, the shares didn't move at all, actually, which just increased the already wide discount out to 70%. But they started to rise now. Nevertheless, there are a couple of very obvious themes here, which are commercial property and commodities. So I'll talk about each of those and explain why I think those have been in favour. And then amongst the fallers, the the figures here are a bit more pronounced. And again, there's a fairly obvious theme here, which is that these are gross trusts on the whole. The Schiehallion Fund, James will remember, I talked about on the December show, December the 3rd, just saying that I thought its 56% premium at the time was leaving it very vulnerable to setbacks. And so that has been, although I also suggested that Chrysalis Investments was quite a lot cheaper, and that is also on this list. So no doubt at all about the flavour here. Apart from the two Japanese, I think these were all gross trusts, or could be classified as such. So on the plus side, first of all, let's just talk for a moment about commercial property, which I think is regarded as something of an inflation hedge. And I think that's the big theme really this month for the risers, the trusts that really proved more resilient in the market. Obviously, we're talking about real assets here, and it's in the nature of these trusts that they do have some inflation protection built into their rent reviews. What is interesting, though, was that it was the diversified property trusts, the old traditional ones, really, which did better this month, rather than the meds, sheds and beds, the specialist ones, which I think are already more highly rated overall. So they didn't have that scope, really, to have a valuation bounce. So I've just listed here in the table the trusts in the sector sorted by the discount to NAV, and that may be a bit small for you to read. But it's quite interesting that there are still some quite chunky discounts in this sector. One that stands out, and it was one of the risers, is Alternative Income REIT, where you've got a 14.5% discount coupled with a 7% yield. But actually that trust didn't fare particularly well last year, and maybe isn't the one you would initially choose. One that stands out to me is Standard Life Investments Property Income, which I talked about last month as being a high quality operator in this sector. And you've still got a 16.8% discount on that with a 4.2 yield. And I think maybe the difference between these and the specialist sector trusts is that the sector trusts are really not valued on their assets, they're really priced on their yields. And because their yields are higher, because they're specialist trusts, you're being paid to take that extra risk, that means that the valuations are higher. So there could be a little bit more scope here, I would think, if inflation worries continue for these diversified trusts to catch up. Another obvious inflation hedge is commodities. And I think we probably all know that intuitively, but it was interesting for me to just get a bit of data on it from BlackRock a couple of weeks ago. And they analysed the 20 quarters since 1998 in the US, which effectively had the highest inflation expectations. I won't go into the methodology, which was comparing the difference in the inflation-linked bonds to ordinary bond yields. But effectively, they found that during these 20 quarters of elevated expectations for inflation, broad equities rose by 7.2% on average, but the commodity-linked equities did much, much better. So copper equities up 12%, precious metals and industrial metals both up around 16% on average during these quarters. So there is clearly a bit of a link historically between these commodity equities and inflationary expectations. But I think the commodity that, above all, is linked with hedging against inflation is gold. And that really hasn't worked well at all over the last year as a hedge. The chart below there is a one-year chart showing that it's had its ups and downs, but it's basically gone sideways. So it hasn't really worked well as an inflation hedge. But I do think that going forward, with our indebted governments, we might see a very attractive combination here of higher inflation but actually still relatively low interest rates, and high interest rates work against gold because, of course, it doesn't yield anything. But that combination, I think, could be very, very effective in the year ahead. And of course, gold is an important component in personal assets trusts. So we'll see what Sebastian has to say. And I think more broadly, actually, there's a very good underlying case for commodities, possibly seeing some further gains. And Olivia Markham, who's the co-manager of BlackRock World Mining, reckons we're about halfway through this commodity cycle at the moment. And there are good reasons to think that we could see another uptick in commodity prices. One really fascinating thing, which I hadn't appreciated until recently, when I heard this actually from a few different investment managers, is the policy shift in China now, which is really bucking the trend of Western economies, where all of our banks are tightening their monetary policies. In China, I think we're about to see a monetary easing, and that's completely different. And it may be that once the Winter Olympics are out of the way, which is a very important PR exercise for the government there, it may be that industrial activity will pick up in China, and that will, of course, help demand for commodities. At the same time, in both Europe and the US, we're expecting more infrastructure spending, eventually when they can get the semiconductors, a bit more auto production as well, as we switch over to electric vehicles. And that leads on to the really key point that in the transition to the net zero economy, we're going to need an awful lot of commodities, and in particular, some of the metals such as nickel and copper. And there's every indication that we're going to be quite short of those, which will be very good for the prices, of course, partly because mining companies have been unusually restrained actually over the last cycle with their capital expenditure, and they've been paying it back to shareholders rather than spending it on speculative new developments. And that means that production has really not moved ahead. So Chile, for example, the world's largest copper producer, is producing less copper now than it was 6 years ago. So we could be in for a bit of a crunch. And in the investment trust sector, you've got BlackRock World Mining is the only really large, very liquid trust there, and that's trading close to NAV, but that's an obvious choice. And then you've got special situations. I talked about Riverstone Energy last month, and that had another very good month actually, and was up about 14%. Geiger Counter is obviously specific to uranium. And then you have got some smaller trusts as well, like Baker Steel Resources Trust, which is trading on a wide discount. So I think it's a reasonable suggestion to think that you could blend these to take advantage of the discount as well as the underlying strategy. And moving on to the fallers, clearly what's been happening is a big rotation out of growth. I'm sure you're all aware of that. You don't need me to explain it. But there's been this shift out of long duration assets as interest rates start to rise. I was quite amused by the very plain speaking John Bennett, who's the manager of Henderson European Focus Trust, who said the only surprise for him was it's taken so long for this sell-off to arrive. And of course, we have been seeing these charts for many, many months now of the extreme position of growth stocks against value. So this has been a sharp sell-off. And I think if you're looking at the S&P 500 or the Dow Jones, if you're old-fashioned like me, then that probably disguises the strength of the sell-off actually amongst the tech stocks in the US, which has really been very substantial. And we saw some of them come down really sharply, like Netflix, which was down 35%, just before one of our favorites, Pershing Square, decided to buy in, classifying it now as a value stock. And it's quite an interesting situation just now where it does seem as though that initial immediate sell-off is probably over. But then this week we saw the terrible results from Meta, which caused another jolt down. So markets are still quite nervous. And just finishing off here with exactly what that means for the investment trust sector. Clearly, many investors, if not most actually, have holdings in Baillie Gifford managed trusts, which are very specifically targeted at the growth sector. And I've had a lot of questions about these. The premium, first of all, on the Schiehallion fund has moderated somewhat, but it's still 33%, which would worry me at this time. I think you're paying a very, very large premium there for an increasing amount of risk. And interestingly, Chrysalis Investments, which I think is somewhat akin to it, has fallen to a discount of 26%, not helped by the press coverage of its enormous performance fee. But actually, I listened to a presentation this week by the manager who tackled that head on, and it seems to me that there's a lot more value in Chrysalis than there is in Schiehallion. I've been asked almost every day about Scottish Mortgage Trust, obviously the most widely owned, largest trust, and also Edinburgh Worldwide, the smaller companies, global smaller companies, which had a very poor year last year. What is interesting here, and I'm cribbing from a broker here, is that they have both recovered from very large drawdowns before. And I think actually, if you have a long-term view, there is an argument for averaging down and keeping faith actually with the managers. But what I also think is that it's very hard to give an opinion on this at the present time, not just because we're very much still in the midst of this, but also I think there's so much market noise at the moment that was illustrated this week by the string of results from the FANG stocks in the US, where Alphabet actually produced very, very good results early in the week. And we thought, that's great, that signals the end of this sell-off. And then, of course, Meta came the next day with terrible results, so the market plunged. And then last night, Amazon had excellent results. And so, again, people are feeling a bit better about it. I think against that background, it's very difficult to give very, very firm advice. So I would be cautious of anyone who is really giving you black and white advice on this part of the market. It's clearly a period of great uncertainty. I think we can expect additional volatility. And against that background, it'll be really fascinating now to hear what Sebastian has to say. Thank you very much.
Thanks, Andrew. We had one question while you were talking, which was, do you know how long those commodity spikes lasted for? When you're talking about the BlackRock?
I think if you look at a chart of global commodity prices, they've been rising now for about 2 years, and typically a cycle will last for maybe about 3 or 4 years. But interestingly, Olivia Markham certainly argued that this cycle might be somewhat extended because of this restrained capex, which means